All right, guys. So I got the top 5 stocks for June, and Stock Watch Sunday obviously looks a little bit different right now. So if you guys are new to the channel, I usually go live on Sundays for Stock Watch Sunday. This is a little bit of a different flavor, and I want your guys' opinion on this. I'm going to do Stock Watch Sunday in pre-recorded form. It is a little bit different, but I've noticed that there's been a downturn in people tuning in for Stock Watch Sunday, and I just wonder if maybe it's because it's getting nice out. People don't want to be stuck at home watching me on a Sunday night, which I totally understand. So I'm going to do it pre-recorded, going to put it out a little bit earlier and see how that goes. But let me know in the comments what you think. All right, so the top 5 stocks for June is a very interesting one. We're seeing a bit of a different turn in the market overall. There's a potential bottom in the S&P 500 that we might have witnessed over the last couple of weeks, and things have been beaten down to a pulp, right? It's been really rough for a lot of stocks. And the first stock that I actually have that I'm watching for the month of June that I think could outperform is none other than Affirm. It's part of a $10 trillion market. The buy now, pay later structure is heating up rapidly, and their last earnings was incredible. And to me, the expansion of their partners has been the real key here. They're operating at a loss, which in this environment, it remains super sensitive because of interest rates going up, right? That's going to affect their bottom line. But the growth story is what's really incredible. Affirm right now, it has been down 87%. We take a look at the chart right here, and I'll share my screen with you guys so you can kind of just look at this daily chart. Unbelievable, right? $176.65, and then went all the way down to $13.64 as the all-time low for Affirm. There's a lot to like here, though. We're seeing consumer spend continue to increase, and actually credit balances are also increasing. So to me, I think that spells the buy now, pay later space could become a lot more attractive. I just think that with consumer spending moving up and this becoming kind of the new way that millennials and Gen Zers kind of put things on credit, I just feel like this is going to continue to become more and more of a trend. They used to have, when they first came on public, the big partner they had was Peloton, right? Well, they've done an amazing job at expanding that portfolio. Now they have Apple. Now they have Amazon. We've heard Lowe's, and they're getting in with Airbnb, and you can now buy your vacation now and pay for it later. This, to me, I think is what's really kind of the booming underlying business that is Affirm. You know, we look at active customers over since the Q3 of 2021, they were at 60% year over year then. Now it's around 150% year over year on growth. There are now 12.7 million active customers using Affirm, and that figure is growing by triple digits, as I had mentioned, over the past several quarters. Those customers have generated total transaction revenue of around 13.6 billion just over the last year. So you can imagine how quickly this is growing. They also have a partner with Shopify and continuing to grow that as well. Their online checkouts climbed to 207,000 in fiscal Q3. That's an increase of 1,698% year over year. Unbelievable numbers for Affirm as far as growth is concerned. And yes, still operating for a loss, but they need to in order to continue this ship to grow. This is not the same as growing at all costs because the losses are remaining small. But as you can see on the chart here too, there's a lot of value to be had. It got ridiculously oversold on RSI around 22 and has started to make that move. And it just broke a crucial resistance at 25. As I'm recording this is now sitting at $27.82. And yes, it's up 20%. But considering that it was down 90, this has a lot more room to go. Watch for Affirm to test that 50-day moving average around 33. As you can tell, I'm pretty excited about this stock, and I think that there's a lot more room for this to run. The next one that I'm going to be covering here is none other than CrowdStrike. CrowdStrike has been beaten down like crazy, and for good reasons. The multiple is extremely high. PE on this is at around, oh my gosh, I mean, it is extremely high. But the cybersecurity space is growing so fast that investors are willing to pay a premium for it. Yeah, it's 142 times next year's earnings. So still sky high, but they are making money. They are profitable, and they're still growing ridiculously well. One thing that I think that can't be overstated here is that we just saw earnings from Palo Alto, which also has a high multiple. It's around 60 times next year's earnings, well above the standard of the S&P 500, which is around 17. But the growth is what makes this more attractive and what makes investors willing to pay the premium for something like cybersecurity. We look at the amount of ransomware attacks that we've seen, not just from Russia, even though that has exasperated a lot of this, but from other areas as well. China certainly attacking some of these smaller businesses. I'm not saying the government is, but that's where the cybersecurity attacks are coming from. So this is continuing to become a thing. And as more and more companies adopt hybrid or work from home approach, the need for cybersecurity is going to become increasingly high in demand. So that's going to be something that you definitely want to take a look at. Here's the chart on this. I think that there's potential argument that you can make that it bottomed at around 130. And actually, there's a nice support here around 136 or 137. It's up around 7% on the day as of this recording. But I like it here. I think that there's definitely a lot of promise, especially considering the nice bounce that it's had off of that support. It was very oversold back in the beginning of May and hasn't really looked back since. Considering the fact that this was nearly a $300 stock, it's down 50% from its highs. As I had mentioned before, of course, the forward PE remains a concern, but the growth here, in my opinion, is extraordinary. Its revenue rose 63% to $431 million, as its adjusted earnings per share surged 131% just in 2022. Its total number of subscription customers jumped 65%. Existing customers use more than 22 cloud-based modules. So this, to me, is just one that I think that you should certainly look at. And yes, the PE is high, but that growth is extraordinary. That's faster. That growth is faster than Tesla. I mean, just to put it in perspective, that is insane. So to me, I really like CrowdStrike. I think it's one to watch for this month. So look for a nice bounce there. The next one that I'm going to be covering here is none other than American Express. American Express was known traditionally for those who had higher income, for people who were a little bit more affluent. Then you would be awarded an American Express card. But American Express has shifted a little bit and turned into being more attractive for millennials and Gen Zers alike. One of the big reasons is because American Express does really well, and one of their biggest revenue driver, gosh, couldn't talk on that one. Their biggest revenue driver has a lot to do with travel. And what do millennials and Gen Zers like to do? We like to experience things. I myself am a millennial, and I'd much rather go out and travel and experience things than actually have physical, material things in my pocket. So to me, I think that's why they made the huge shift here. I really like American Express. The stock has fallen to a point to where I think actually is really attractive. And we just talked about how CrowdStrike was a high multiple. American Express is anything but. It's one of the top 10 holdings that Warren Buffett has in his portfolio. And we look at this one with the forward PE of around 16 times next year's earnings. And the growth here has been pretty substantial amongst the millennial accounts as well, up 35% in an increase of accounts. And we're seeing revenue also match those numbers as well. The revenue is set to increase 18 to 20% year over year just in 2022. Travel and entertainment, which typically is an important category, as I had mentioned, is still a little bit down compared to pre-pandemic, but we're getting there. I mean, we've heard record numbers and record demand coming from United Airlines and Delta as far as air travel is concerned, and American Express stands to benefit from that. Let's not forget also that they have a pretty decent dividend yield as well. I like this one going into the summer months. As you can see on the chart, it settled out around 152. It's up around 3.5% as of this recording on the day. But I think that there's also a really nice case that you can make that perhaps this gets back into this wedge. I have this wedge drawn here out for you guys, and we have the 200-day moving average sitting at around 172.97. We'll call it 173, 176 also on the 50-day. To me, I think this is actually a pretty decent area to watch for resistance, but that also means we got some room to run here. 166 is where this trading at. 173 is where the 200-day is. That could meet that first resistance. I really like an American Express here, and definitely let me know what you guys think about this list so far. How am I doing? Let me know in the comments. Are you agreeing with this so far? We got 2 more to go, and I think that you're going to like these as well. So let's go ahead and get into it. Facebook, all right? It got absolutely trounced in this market all year long, and the blows just keep coming. Snap came out and intra-quarter lowered their guidance. So before the earnings came out next time around, they lowered their guidance right in the middle of it just this past week. and Facebook took a huge dive on top of already a year where it has not been good for the company stock anyway. We are seeing a potential slowdown in advertising. I mean, that's not, we can't understate that. But I think that we're getting to a point on Facebook to where it is getting so bad that it actually starts to become good. The forward PE on this is ridiculous. Let's not forget, Facebook in comparison to Snapchat, there isn't one. This is a company that has $40 billion in free cash flow every year, and they are absolutely killing it still. Yeah, of course, we're seeing a bit of a slowdown, but that means nothing. To me, I think that, I won't say it doesn't mean, it means nothing. I will say that I think that it is should be taken with a grain of salt, because advertising is cyclical, and I think that there is a case that you can make for that. Let's not forget that this is also the cheapest of the FANG stocks as well. Facebook, or Meta Platforms as they want to be called now, is now trading at a forward PE of 16 times next year's earnings. This got as low as 14. So forward PE is still very cheap on this. Still trading below what the S&P is, and the growth trajectory deserves a premium, in my opinion. I think that this could easily be traded up around 22, 24 times next year's earnings, and nobody would blink an eye. So looking at Facebook with that type of free cash flow, with the amazing fundamentals that the stock has, yes, we're seeing advertising slow a little bit, but it's going to hurt Snap a whole lot more than it is Meta. And I think, in my opinion, this one looks like it's a really solid buy, given just how cheap this actually is. Could it go lower? Sure. There's definitely some risk involved with that, especially if we hear not so good numbers on their next coming earnings. But that being said, we won't hear from their earnings again until July. So we got some time for Facebook to kind of get back on its feet. And I think that June could be that month where we start to see this certainly move up. The last one here that I think a lot of you guys are going to like, and that I am super bullish on, and I own myself, is none other than SoFi. SoFi has been beaten into the ground. And I think it's been extremely unfair to the stock, considering that many of the investors here have been selling because of the student loan moratorium. So SoFi used to, and they still do, but one of their biggest revenue drivers for the company was refinancing student loans. They made money off of that, and that has been a huge part of their business. But they've been expanding, and they've been growing like crazy. Let's take a look at the chart here on SoFi. You can see how much this has gotten beaten down. It went up as high as $28 all the way back in January of last year, and hasn't really sniffed that number. We saw returns to highs of around 25, and then again try to test 25 back in November. And you know what the story is with most of these tech stocks. Let's draw a couple of trend lines here. So here's one here. You can see lower highs, and it's really been following this lower low. So from a chart perspective, it's still in a downtrend, but I think that we're starting to see a little bit of a turnaround. We're trying to test this 50-day moving average. As of today, it's trading around $7 a share, and it is operating for a loss. So consider that. That is certainly something to worry about, especially in an environment where we're seeing a rising of rates. But also, the other side of this coin, again, as I'd mentioned, is the growth. The total members last year rose 70% year over year as of this last quarter. So I won't say over the last year, total members rose 70% to 3.9 million. SoFi posted a record adjusted net revenue of $322 million in Q1. So these are these past earnings. It was a 49% increase year over year, and it reported a pretty decent loss of $150 million for the quarter. So that certainly is still a concern, as I had mentioned before. But from the $178 million loss that we saw in the first quarter of 2021, that's a significant improvement, and that's with a student loan moratorium in place. Imagine what happens when this stock when we start to see that come back, which in my opinion is a little bit of a ways off. I think that we won't see the moratorium end until probably 2023. So keep that in mind. But in my opinion, the growth story here on SoFi is so significant. And let's not forget, they have a bank charter. They also are getting into the brokerage game. There's a lot to like about SoFi, and it's not just about student loans here. In my opinion, they have so much else going on, and the market cap here is a joke. It is actually less than what it costs to build SoFi Stadium in LA. How crazy is that? So in my opinion, I really like SoFi here, and I think if we can break up over this 50-day moving average that sits at around 765, then we could see some significant movements. We haven't seen this trade over the 50-day moving average since November of last year. So this will be a significant development on SoFi if it does indeed have a close over that 50-day moving average. If it happens this month, I think we could see some decent FOMO kick in on SoFi, and it could really start to make the move. Let me know what you guys think in the comments below on these top 5 stocks. And I'll be back tomorrow at 3:45 p.m. Eastern time to cover the earnings and whatever else is going on in the stock market. So make sure you're subscribed and hit that notification bell to get notified when I do go live, and I will see you guys then.